Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This is just showing some of the idea of the amount of debt per person in the U.S. economy, and needless to say, this is going up, quite fast, given the fact that the government keeps throwing more stimulus and more stimulus into the market, providing more and more public leverage into the market, in a market that we see that got into the problems because they had too much leverage in the first place. So it's an interesting policy choice given the history of what created the problem in the first place. But the reality is, because the amount of money that they've thrown in, especially the increase, and I had an email today from a gentleman saying that the increase in the money supply is so huge, this is a huge problem, where the reality is there's a lot of behind the scenes on the private sector. Think of the economy as two sides of the fence. You have the government side and then the private side of the fence. In the global economy, the private side of the economy is still much larger than the government side or sector of the economy, if you want to break them into two sectors. So the amount of deleveraging going on in the private side of the global economy is still outweighing the amount of stimulus that the governments can throw in, and that's why you're seeing so little traction given all this stimulus. And they've thrown in about $35 trillion since the G20 meeting, the major industrialized economies in the world. And you're not seeing the stimulus because prices are falling basically everywhere. You wouldn't see prices falling to the degree they're falling everywhere. And again, today prices were lower than expected on PPI. I think they came out today. It's the case, like I said, in every industrialized area. And prices are even falling in China, given how much stimulus they've thrown into the market. That's an example of the private deleveraging still overwhelming the government stimulus here. So it's not always a done deal that this massive run-up in federal debt will lead to a massive inflation. In fact, the government, you got to think at some point we'll be running out of money, or at least running out of our money to throw into the economy. And if the private sector continues to deleverage, and we have some major continued dislocations among the major trading partners, deflation, or the idea of a deflationary spiral is real out there, which then goes to change the game in a very, very big way. Then you would start to see many, many years of low growth in the industrialized economies in the world, and this debt would ultimately have to be eaten away and finally come off the table in order to provide new and real growth going forward. So it's not that this debt can't ultimately be mopped up, but it will be painful given how fast they're throwing it into the market at the moment. I hope some of that makes sense. This is a very esoteric subject to a degree, so feel free to ask, throw some questions in there. So what would be the major fallout if this idea of the U.S. is losing its reserve currency status, and what would we probably start to see? We'd probably start to see a move to some type of global currency basket for global commodities. And it would include, and OPEC would probably be the driver here, because the oil price is really to watch. If OPEC and the other oil nations start to get very concerned and say, we don't want the oil priced in dollars anymore, that would be a major hit to reserve currency status. So OPEC and oil is where to watch. So maybe they go to something like a 50% U.S. dollars, 30% euro, 10% yen, 10% pound. I'm just making these numbers up, but I think they make some sense given the relative distribution in the global economy. So just the fact we go from 100% of the U.S. dollar to buy oil, or close to it, not including Iran, down to 50, right away, that says, as I said earlier, that says that countries that want to buy oil have to hold about 50% fewer dollars, which means all those dollar supply comes on the market. We're starting to see these individual country agreements that people are concerned about, that are starting to chip away again, or at least provide the sentiment that the U.S. dollar reserve status is in jeopardy, and China-Brazil trade deal. And China, as I said, China is trying to replicate that. No doubt China wants to become a major world power and ultimately take over the baton from the U.S. So they're going to continue to do this, even though from a financial system sophistication standpoint, they're not even close to ready to really be a reserve currency on a whole lot of levels. But they'll continue to do this again, and probably, again, it just depends on the course of China's economy takes going forward. But if they continue to move in a secular bull market as they have, these deals will probably continue to be replicated, especially for those countries that don't like the U.S., which I'm sure there are plenty out there. Right now, as I said, we're coming out of this. Well, if we are coming out of this dollar bear market, we'll probably see as the U.S. starts to rebound in price, the distribution of holdings at about 70% of the U.S. dollar. That's huge. That's as high as it's ever been in terms of the dollar's world reserve currency status. Back to the idea of debt. If the AAA credit rating status is in jeopardy for the U.S. Treasuries, these major central banks around the world have a fiduciary responsibility and would probably reallocate a lot of these reserves, or at least a good portion of these reserves out of the U.S. dollar and into either some type of basket or more into euro, pound, yen, maybe even some type of Asian bloc currency that could start to develop. It's hard to say, but no doubt that would be the driver of this. But as I said, as you can see, the U.S. dollar's penetration as a reserve currency has actually increased over the last few years and not decreased. They would probably, base it on some type of trade-weighted terms also, where the dollar is now relative to where the dollar would be then once the AAA status was lost compared to where it is now. Needless to say, if the U.S. loses its reserve currency status, as I said earlier, it would be a major hit to the U.S. GDP, or could be a major hit to the U.S. GDP. Does not have to be, given how it plays out. But it could be, because as I said, the U.S. is the major driver of global demand in the world, and U.S. purchasing power declines. It's a hit to U.S. wealth, and this type of thing tends to self-feed for a country in a very, very big way. And if we're saddled with that debt, and our purchasing power is declining, and the government has tax rates, 50, 60, 70% in order to pay back the debt, there's where you get the self-feed and a downward spiral, the inability for private sector to really rebuild wealth again. So that's really the scary major potential fallout of this idea of the U.S. losing its reserve status, which goes with the idea of a longer-term decline in the U.S. economy in the world. Another point, and this is an important point that I think is really critical, and again could play out both ways, this idea of the U.S. consumer status at risk. I keep saying, and I think most people would agree if they look at the numbers, the U.S. consumer is the biggest driver of global demand. And right now, Japan, China, Asian markets are really beholden to the U.S. consumer because they have export-denominated economies, meaning they're set up to ship goods to the West, the U.S. consumer being the poster child there. They tend to recycle those major trade surpluses back into the U.S. economy in order to hold treasuries to try and keep their currencies in check. Obviously, China does it explicitly. Japan, not so much, but to a degree. And the other Asian countries do it also implicitly and explicitly. They suppress their currencies because they're export-driven economies, and they suppress their currencies in order to be more competitive on trade.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.